Welcome back to Peter Lynch's Investing Style with Ordinary Investors with Extraordinary Returns, Part 2, Picking Stocks. And if you're interested, consider joining with the link down below to get my personal journey on investing being shared with you with stocks that I'm currently buying or selling. And if you enjoy the episode, make sure to like the video, subscribe, and hit the bell if you haven't done so already. And as usual, here is the organization table explaining where things are and what's included in this video. Now a stock has your attention that you found with your edge. But here's what Peter's trying to do with his books. Phase 1 of the book is trying to discover your qualitative advantages. And then phase 2 of his books is do at least basic quantitative research. Alright, so chances are that you found something cool using your edge. Your question is probably, do I buy the company that's selling it right now? No, that's dumb. You need to actually look at the company first. Investing without research is like playing stud poker and never looking at the cards. I'm all in. Would you like to look at your cards first, sir? Peter thinks people spend more time analyzing which brand of toilet paper or refrigerator they want to buy than they do with their investments. We should spend as much time picking stocks as we did this fridge. Oh, I already bought this one stock because someone mentioned it in a blog. I put half our life savings in it. What's wrong with you? You should check the bottom line. Just because the product is good doesn't mean the company will explode in value. You might think, I thought that Peter told me to use my edge picking winning products. Why wouldn't the company shoot up in value if I like them? Companies, especially big ones, sell lots of products. Let's look at Procter & Gamble, with Pampers Diapers success. People could tell Pampers was a big hit. It was a mainstream choice for diapers, it's an expensive renewable purchase, and it needs to be bought. So where's the issue, you might say? I identified the big winner item. The issue is that you need to look at the earnings first. What about the earnings, you might say? As mentioned earlier, companies sell a lot of products. You're going to have to find answers to these questions. Some questions that you need to find answers to include, what percentage earnings does that product make? How much of an increase will you expect in the coming few years? And are the other areas of the business doing well too? Now let's get into some famous numbers. The percent of sales. This is the really important number to look at when you find something with your edge. How much impact does that product or service have on the company you're looking at? Let's say you know that some new plastic is going to explode in popularity. It's lighter, more durable, biodegradable, and, the best part, it's cheaper than the other methods, which means it's actually going to get used. Why is percent of sales important here? Well, who gets excited about plastic? Let's say two companies sell that amazing new plastic. Mega Company A, where percent of sales for this plastic is 2%. Heavily diversified, and plastics only makes up about 10% of the business. Versus Medium Company B, where percent of sales for this is 30%, and almost all revenue comes from plastics. Using your edge plus market research, you believe that the sales of this plastic will double within 2 years. Which of these companies would you want your money to be with? Clearly, the Medium Company B would be better in this case. A larger percent of their earnings comes from what you believe will be a big winner. Percent of sales helps you determine, 1, if your winning product will make any impact in the company, and 2, how much risk you're placing on being right. Your edge, which gives you confidence that you will be right, helps determine risk so that you can end up the big winner. Next is probably the most famous, which is the PE ratio, and this one is talked about constantly. It's how much you're actually paying for the company and the earnings that it has. And since stock prices are changing every day, that means that the PE ratio is also changing every day. What's the rough rule of thumb that Peter uses? The PE ratio of any company that's fairly priced will equal its growth rate. What's he saying here? If the PE is 20, then a fair price would be to assume 20% growth rates in the earnings. What about dividends, some people might say, and we'll get to that later. What earnings numbers does he look at? Number 1 is the average earnings growth rate for 10 years. Number 2 is the average earnings growth rate for the last 3 years, and that's just for the rough estimations. Also, ideally, the last 3% would be better. The purpose of any company is to grow that money into the future. Thus, you'll be looking for the future growth rates. Past growth is technically worthless. However, it's nice for a rough estimate. Future growth rates, you might say. How do I get that number? And Peter says, your guess is as good as mine. That's what makes investing so hard. Well, what about companies with dividends? And no, we aren't ignoring dividends. Peter has a slightly more complicated way to look here. Growth estimate plus the dividend yield divided by the PE ratio equals some number. So for example, 15% growth plus 3% yield divided by 12 PE gives us 1.5. Well, what's this number useful for? It's for more rough estimations. Clearly, you're still going to have to find the qualitative advantages of companies and also factor in the debt obligations and other factors such as that. However, this is a nice starting point to possibly find great choices. So the numbers guide goes like this. Less than 1 equals a potentially poor choice. Equals 1.5 is a potentially fair choice. And anything above 2 is a potentially great choice. So go out there and find some big numbers for me. Then there's the cash position. He loves the bonus cash, money after debt. Like some delightful hidden rebate, is what he says. Peter considers the cash position like this. The stock is sitting at $50 per share. Each share holds $15 in cash. Thus, the price was $35 per share. He also considers this when taking PE into account. For example, we have our example that we talked about previously, the $50 stock price with the bonus cash of $15 going back to $35 per share. Now, assuming the EPS on this stock is 5, that would mean that the market PE would be the 50 divided by 5, which gives us 10. However, the rebate PE is 35 divided by 5, which gives us 7. Try doing calculations with both. Then there's the dividends. And the famous Rockefeller quote, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." There's certainly a lot to like with dividends. He wants to see if the company paying a dividend is helping or hurting them. Here you go. Thanks. Big issues he's seen is bad management plus no dividend. We mentioned previously about getting a rebate. Why not always stack cash then? Good management can really make the difference in this. Bad management can get creative with losing money. Number 1 is diversifications, which is, in his eyes, buying bad acquisitions with low synergy in the company, usually at bad prices as well. Number 2, increased risk-taking, thinking there's a safety net so they don't do things rationally. And 3, stock options for management for their good work. And he feels that having a dividend makes them more cautious and less likely to make poor choices in this manner. Dividends are also nice to help reduce dramatic drops. When the price drops, that means yields go up, and having bigger yields makes the investment more attractive to purchase at the time. Being more attractive means more buyers, and that can help prevent dramatic price drops in the future. However, the company cutting or removing dividends will often cause the drop to be significant. Dividends are a choice, they are not mandatory. So if they are so great, why doesn't every company do it? Sometimes companies should retain the money. Are they in a competitive space where cash on hand is useful? Is this a small company with great internal returns? Does the company have a lot of debts and need to retain cash? Should I stay or should I go? Then there's book value. The flaw is that the stated book value often bears little relationship to the actual worth of the company. It often understates or overstates by a large margin. Supreme! I have 50 shirts. Each one is worth $300. Overvalued assets can be presented on the balance sheet. Raw materials are easy to determine asset values for, such as cotton. Branded shirts are much trickier to price in. What's the value of putting it all together? I'll sell you some cotton for $300 per pound. No thanks. Inventory that keeps piling up can be listed as assets, even if nobody has been buying it for years. You should determine the book value yourself, not take it for granted. That's how you can find asset plays too. Am I assets or junk? Then of course there's the growth rate. This one's critically important. It's the essence of finding the 10-bagger. Growing big and strong is super important for smaller companies. That's the only growth rate that counts, earnings. Does your company get progressively better earnings numbers? How much better? What's the percentage? And how does that percentage compare to the PE? And he's talking about earnings growth rate, not expansion. Just because the company has 10 new stores doesn't mean that the earnings are increasing. So would you be looking at low growth rates with low PEs or high growth rates with high PEs? Let's take a look at this chart where we have company A, which has a 20% growth rate each year, versus company B, which has a 10% growth rate each year. At the start, they each start with $1 per share. But over 10 years, company A gets to $6.19 per share versus company B, which has $2.59 per share. Okay, so obviously more growth gives better earnings over time. What does that do to my investment? Well, let's see the numerical difference in our investments. Let's say the 20% growth got a fair PE of 20, and let's say the 10% growth got a fair PE of 10. Assuming the 20 and 10% growth happened yearly, and the PE being paid is still fair relative to the percent growth in the last year, this is the difference in our investment between the two. Company A, which was the 20% grower, is 20 for the PE times the 6.19, which gives us $123.80 per share, versus Company B, which was a 10% grower with a 10 PE. You get the 10 PE times the 2.59, and that gives us $25.90 per share. Now we'll get into the 6 categories of stocks, and the first of which is the slow growers, things like electric companies. The slow growers are usually large. Most of the earnings are given to shareholders, so they have some sort of stream of cash flow that goes into the company, and from that company it is given to you. And with slow growers, there's often not much room for growth. Oftentimes the market is saturated and there's only a little bit left to grow into as the years go on when there's more and more people. So finding success with the slow growers. Their evaluations lie with their dividends. Why else would you invest here otherwise? You can get more growth elsewhere. Number 1, how safe is the dividend? And number 2, what rate can they increase the dividend? And number 3, would they ever need to cut the dividend? So as far as Peter's opinion goes on the slow growers, he's not a fan of buying any slow growers at all. It doesn't fit his investment strategy. But if you want to, that's a different story. Maybe you want to build a stable dividend portfolio. Because you are not the same as Peter Lynch, that does not mean that you should not be buying any slow growers. That is just his opinion. The second of Peter Lynch's categories is the stalwarts, companies like Johnson & Johnson, otherwise called the blue chip companies. Typically, these companies are also slow, though not always. It depends on what products and services they're bringing out that appeals to some sort of market they're moving into. So they might be a snail, but this time they're on a skateboard. So just like before, the stalwarts are also large. With stalwarts, they usually pay dividends but continually gain capital appreciation as well. So we have the cash flow from before plus the capital appreciation to look forward to. As far as finding success with the stalwarts, Peter says that it's picking great stalwarts comes down to buying at the right time, when at a discount, such as is there temporary bad news pushing the price down that won't be actualized in the earnings in the future? Is it uncharacteristically trading at a lower PE relative to past performance? Is that justified or an overreaction to something? Peter's opinion is that he only says he keeps a small percentage of these in his own portfolio. Good to hold in hard times, especially the basic necessity stocks. Usually gives decent returns, but don't expect anything crazy. They're not bad, but they're just not great. Number 3 is the fast growers, such as the newer companies. The ones capable of enormous growth. They usually don't pay dividends. Their money is better used to develop the company. Keep the earnings. It's providing more value to shareholders to do it this way, because if they're making more earnings per share, then that will be reflected in the stock price, giving you the capital appreciation that you're looking for. They do not always go in the fast industries. Peter actually prefers if they don't. Perhaps a new food place competing with McDonald's that is succeeding. Hey, slow down. We don't do that here. And that's exactly why I'll succeed. As far as finding success with the fast growers, number 1 is to use your qualitative edge. Number 2 is being aware of the risks, which can include poor management, being underfinanced, and the ability to be crushed by larger companies, to just name a few of the very obvious risks. And the third point is to look for solid balance sheets and healthy margins compared to others in the same industry. As far as Peter's opinion on the fast growers, he calls it the land of the 10 to 40 baggers. Good stocks for the long term, as long as you're not paying ridiculous PE ratios relative to growth. Pay special attention to their financial condition and pay attention to the debt and how quickly they're going to be able to pay that off realistically. Then there's the cyclicals, the things like the auto industry, the steel, and the chemicals. The ones that regularly have highs and lows. For cyclicals, it's often industry-wide ups and downs, not just individual companies in this area. The timing is everything for the big profits. However, it's extremely difficult to know when's the good time to buy. As far as finding success with the cyclicals, this is largely dependent on using your qualitative edge in this area. Do you work for or with these companies? Do you know why they are suffering? And what would it take to get them out? Your edge is most useful here. If you understand why they're suffering, what it takes to pull them out, then you will be able to determine when you hear news about them making moves to fix those solutions if they're actually going to work. As far as Peter's opinion with cyclicals, he says it's very difficult to do well consistently in this area. Even if you do know things are turning around, it might take a while for the price to change. Only bother with these if you have an edge with them. Then there's the turnarounds, the rock bottom companies, the cyclicals that didn't catch the momentum, the company missing earnings on low profit margins. Turnarounds, these companies are the least related to the general market conditions. They're just trying to pull themselves out of the mud. With turnarounds, these are also the most likely scenarios where investors like you and I can lose the most money in a very quick period of time. Can it even survive its downfall? When will it start turning around? And this is a very dangerous category because they're the most likely to hit $0. As far as finding success with the turnarounds, he says that most of the success will be with evaluating the balance sheet. Just how bad is the debt? Is the debt, with all the principal payments, due soon, or is it far off into the future? So for example, if the principal payments are due within the next 2 years, and these are the years that they're currently having bad earnings, then to make those principal payments, they are likely going to have to sell assets or do something drastic, which is going to be causing a lot of problems. You'll also need a lot of mental conviction, which is very difficult to do. Perhaps you do pick a winner, but it drops 30% more in price. Would you sell or hold on, possibly buying more? Pessimism is at its worst in these situations. You're never going to hear really good stories when things are looking bad for these companies, so it's going to be really difficult to stay strong. As far as turnarounds, with Peter's opinion, he says this is a super dangerous area and to only invest what you're totally willing to lose. Certainly, this can give high rewards. He did it with Chrysler, which was a poorly managed cyclical situation that ended up turning out alright. He says to be very cautious and pay special attention to the debt obligations and those principal payments. Then number 6 is the asset plays, the unrealized gems. These are companies with valuable assets that people haven't properly accounted for. So for an example of these asset plays, In the book, it was listed with Pebble Beach, the real estate company. The whole company was valued at $25 million. 20th Century Fox buys them for about $72 million. Then, 20th Century Fox sells just their gravel pit, let alone all the other assets that this company owned, for $30 million a day later after acquiring the company. This company was valued at $25 million with a $30 million asset sitting right under them the whole time. So it's like, I'll sell you this $20 bill for $10 if you want it. And you say deal, because that just seems super obvious. For finding success with asset plays, it takes a lot of searching, expertise, and patience to win in this category. Searching means finding favorably mispriced assets, which is not easy. Usually, management wants to bolster their numbers, not lower them. And expertise. Do you know how to price the assets better than other people? Possibly from using your edge in whatever industry you're working with, where you have the knowledge to do so. And also, it takes patience, because you need to understand that it might take a while for management, the market, or another large company to realize what you see. So for example, with 20th Century Fox, even if you saw that was a huge asset that they were sitting on, it might take years before another company decides to actually purchase them. Lastly, in regards to these categories, he wants to mention about the shifting around effect. Companies won't be in the same category forever. The story of the company might shift from a fast grower to a stalwart to a turnaround, and so on. You need to keep checking up on your company's story and understand what's happening and whether or not you want to be investing in that company for the given situation. Even though it was a fast grower at the start, maybe you want to sell it because you aren't a fan of putting stalwarts into your portfolio. Now we'll get into the favorable attributes, the things that you want to be looking for. Number one is that it sounds boring. The name puts people to sleep just listening to it, such as Pep Boys, Bob Evans Farms, or Consolidated Rock. The more boring it is, the less people will look at it, and that's the better the chance of finding a deal. But there's nothing dull about making money. Number two, it does boring things. It's the same concept as the last point. If both the name and business is dull, then that's just a bonus. When people finally realize the growth potential later on, now you can sell off to the trendy investors who are just looking at the growth rates. Number three, it's disagreeable or gross to invest with. Disagreeable meaning something that people don't want to think about doing themselves, such as cleaning septic tanks or washing greasy parts. But the only thing you're touching here is the money. You're only putting in the buy and sell orders in the stock exchange within your investing account. So you should buy the icky stocks because that doesn't matter at all. Ew, it does what? I don't want to buy it. Okay, great news for me. Number four, it's a spin-off of a larger company. Divisions of companies into separate freestanding companies. Large parent companies want to see their spin-offs do well. It'd be embarrassing to see them fail. Thus, they start off with great balance sheets very often. So be careful out there, my son. It's a dangerous world. Dad, this is so embarrassing. Fifth attribute is that it's not being watched by institutions or other analysts, something that nobody is even thinking about. You should be the first one to open up the box. You being the only analyst makes what you see all the more valuable. Can't look at that right now. I'm a little busy following Google. Number six, there's lots of unjustified rumors. Talk is cheap, but rumors are cheaper. When people get scared, they sell before thinking about whether or not it's actually true. Is there truth here, or is it groundless? I wonder if this is true. Number seven, it's depressing to think about. Wall Street dislikes the grimy, but mortality is on another level. Companies have a harder time talking with executives. Firms don't want to associate with profiting from corpses. Number eight, it's inside a, quote, no-growth industry. There's nothing thrilling about being in a thrilling high-growth industry. It's a constant battle for companies to maintain the edge. Not being completely up to date can turn on you. Even if you are up to date, no growth industries don't have so much drama. Number 9, it's got a strong niche business. Lower the competition down, and if it's really low, you could have a borderline monopoly. Once that happens, your margins can start growing. Number 10 is that people have to keep buying it. Recurring revenue streams are powerful because it makes revenue numbers more predictable and stable, and you can continue growing them over time. If people have to buy it, then it can also become recession-proof. Things can be close too, like can't imagine living without items, such as internet connection or phone connection, for example. Number 11 is that it's a user of new technology. Technology companies are going to keep butting heads together, and that leads to great products for everyone else. That means your company could drastically benefit from this. Can a scanner cut costs by 3% for stores? Something that simple can make earnings start skyrocketing upwards. Number 12, the insiders are buying. It's a huge tip-off for success in the future. The insiders clearly know more than we do about the company. And he says that in the book, if you see someone with $45,000 salary buying $10,000 worth of stock, you can be sure it's a meaningful vote of confidence. How am I supposed to know when and at what price? They have to list it on Form 4 and send it to the SEC. You can almost certainly find this info across multiple websites. Number 13, the company is buying shares. Shows that the company has confidence and directly rewards investors. When the company buys shares, it reduces the number of outstanding shares. Thus, assuming the same market price, your stock price then goes up. But be a little careful on this one because sometimes they are doing this to benefit themselves. If they have stock options that convert at a certain dollar amount, they might be doing this to meet that criteria and pay themselves off. What would he absolutely ignore? The hottest stock in the hottest industry. One that gets favorable publicity and is talked about constantly. Wow, this is great. So cool. Best I've ever seen. Amazing. These are the problems with these types of stocks. Number 1, if you don't know when to sell, you'll turn profits into losses. And he says, and the fact that you bought them is a clue you won't be. Number 2, high growth and hot industries equals high competition. Analysts getting paid every day to watch these companies' moves. And number 3 is creating a new can't-fail idea isn't everything. You'll need patents and niches to protect your company. And he says, in business, imitation is the sincerest form of battery. Number 1, the thing he would absolutely avoid is the next something. So for example, the next Microsoft, the next McDonald's. Whenever a stock is getting hyped to be a shadow of a popular company, then it is often plagued to be stuck in the shadows instead of being its own thing. We're going to be the next big guy. And why do you think I'd let that happen? Number 2 is companies getting diversifications. Diversification is a word made up by Peter Lynch in which companies make foolish acquisitions that don't directly benefit the company and in fact just reduce the earnings overall as time goes on. Number 1 is for the overpriced premiums on the purchase. Perhaps it is a good purchase, but it is just way too expensive for the company. Number 2 is it's beyond the company's understanding or use, and he'd much rather see share buybacks or increased dividends instead. So for example, we have General Mills in the 60s, in which they bought steakhouses, bought stamps, bought travel companies, and bought Izod shirts. Diversify, right? Number 3 is the whisper stocks. The whisper stock is also known as the long shot or the whiz-bang story. These are companies on the brink of solving some major problem, and wouldn't you guess it, they do it in an unconventional way. So for example, you might hear from Smith Labs with papaya juice to cure slip disc pain. This company will cure cancer by using fruit juice. I think it's a buy. Wow, she's crazy. Number 4 are the middleman stocks. Companies that sell more than 25% of their revenue or earnings to a single customer. If the loss of just one company is devastating to their revenue, it's a dangerous position in your portfolio. Big companies will most likely be looking to cut the middleman, and it's only a matter of time. So even though they both use the middleman, both of them are just thinking that they can't wait to get rid of this guy. Number 5, stocks with exciting names. Things people fall in love with too easily, such as advanced, leading, micro, X, literally anything with an X in it, and funny acronyms being put in the ticker. This stock is so cool. I want to buy it. So do you like Peter Lynch? If you like his style of investing, then get his books from the description down below. Those are the books that I read to make this video. His books will give diagrams and charts to help you learn, and his writing is very humorous and easy to read. And did you learn something new or think about investing in a new way? Then smash the like button to show you enjoy these videos. And subscribe and hit the bell if you're new here. These types of videos take a long time to make, so it's greatly appreciated. Thanks for watching.